Right now, you can lock in a guaranteed return of 2.7% above inflation for the next 30 years. That rate is higher than it's been at almost any point in the last decade. Most investors have never heard of the trade that does this. It's not a stock. It's not crypto. It's a boring government bond most people scroll right past. But a recent MarketWatch analysis called it the bond deal of the decade. Today, we're breaking down what this trade is, why the math works specifically right now, and why almost everyone, including maybe you, is calculating real interest rates wrong. By the end, you'll know exactly how to evaluate this for your own portfolio. Let's set up the comparison. It's simple. On one side, you have a traditional treasury bond or a CD. This is the default safe portion of most portfolios. It pays a fixed interest rate, no matter what happens to inflation. On the other side, you have something called a TIPS ladder. TIPS stands for Treasury Inflation-Protected Securities. These are government bonds specifically designed to adjust with inflation. Both are backed by the same government. Both are considered safe assets. The only difference is what happens to your money when inflation surprises you. So before we go any further, just ask yourself, which one sounds like the better deal today? The reason most people get this wrong comes down to a single critical mistake. Most retail investors believe that real interest rates, your return after inflation, are low or even negative. But that belief is based on comparing today's bond rates to last year's inflation. And that's not how it works. To understand why, let's start with the familiar side of the equation, the traditional bond. Traditional bonds are simple, and that's their main appeal. You lend the government money for a set number of years, and in exchange, you get a fixed nominal interest rate. Let's use a round number and say you get 4% a year on a 10-year Treasury note. That 4% will never change. It's predictable, easy to understand, and for decades, it has been the go-to safe money choice for retirees and conservative investors. The problem is what that fixed rate doesn't protect you from inflation surprises. If inflation runs at 2% a year for the life of that bond, your real after inflation return is roughly 2%. That's solid. But what if inflation runs hotter than expected? What if it averages 5% instead of 2%? Suddenly, your real return on that same 4% bond drops into negative territory. You are locked in at 4%. The bond doesn't care that your grocery bill or your gas prices just went up by 5%. Your purchasing power is shrinking. And this isn't some ancient history lesson. It happened as recently as 2021 and 2022. Inflation spiked well above what bondholders had priced in, and anyone locked into a low fixed rate bond from a year or two earlier watched their real purchasing power get quietly eaten alive, even while their account statement showed the exact same nominal number. So traditional bonds give you certainty about the number on your statement, but they offer zero certainty about what that number will actually be able to buy you in the future. That's the trade-off. Now let's look at the other side, the one most investors have never really explored. TIPS work almost exactly like a traditional bond, but with one crucial difference baked right into their design. With a TIPS bond, the underlying principal value, the amount your interest is calculated on, adjusts with inflation based on the official consumer price index. If inflation runs hot, your principal goes up right along with it. If inflation is low, your principal grows more slowly. But either way, you are always guaranteed your stated real return above whatever inflation turns out to be. Your purchasing power is protected. This is where the current opportunity becomes so compelling. According to the Cleveland Fed's inflation expectations model, which is a sophisticated tool that draws on Treasury yields and market data, the numbers right now are historically attractive. The 10-year real yield is currently sitting at 2.1%. That's 1.2 percentage points above its own 10-year average. The 1-year real yield is at 2.2%, which is a full 1.9 percentage points above its 10-year average. In plain English, this means that the real after inflation returns you can lock in on safe government debt are significantly higher right now than they have been for most of the last decade. To make this concrete, imagine building what's called a TIPS ladder. This means buying TIPS with a range of different maturity dates, some short-term, some long-term, so that one bond matures each year, providing you with a steady, predictable stream of income. According to data cited in that MarketWatch analysis, a 30-year TIPS ladder built today can produce a guaranteed inflation-adjusted annual withdrawal rate of 4.9%. The underlying real yield on that ladder is 2.7% per year. For comparison, just a few years ago, the withdrawal rate on the exact same kind of ladder was just over 4.0%. The deal available today is meaningfully better on an asset that is explicitly designed to never lose purchasing power to inflation. But tips aren't flawless. Their market prices can fluctuate before maturity if you need to sell early. And there's a lesser known tax quirk that trips up a lot of first time buyers. That quirk brings us to the most important part of this whole discussion. Here is the aha moment. This is the reason the opportunity exists right now. Most people, when they hear real interest rates, assume you calculate it by taking today's bond yield and subtracting last year's inflation rate. Using that method, with inflation having run hot recently, real rates look low, maybe even negative. That's the popular narrative. It is also, according to how professional bond markets actually price these things, the wrong calculation. The correct way to calculate a real interest rate is to take the nominal yield and subtract expected future inflation, not trailing already happened inflation. When you do the math that way, using the same forward-looking models the professionals use, you discover that real rates aren't low right now. They're significantly higher than their 10-year average. This matters because it flips the common wisdom on its head. The belief that rates need to rise further before it's a good time to lock in is backwards. The opportunity is already here, priced into the market, and it's being missed by anyone still doing the calculation the old way. Now for the second hidden factor, the practical catch. TIPS can generate something called phantom income. Each year, as your TIPS principal adjusts upward with inflation, the IRS treats that adjustment as taxable income for that year. The problem is you don't actually receive that money in cash until the bond matures or you sell it. So if you hold TIPS in a regular taxable brokerage account, you could owe taxes every year on gains you haven't actually collected. The fix is simple, but it's a step people often skip. Hold your TIPS inside a tax-advantaged account, a traditional IRA, a Roth IRA, or a 401k. Inside one of these accounts, that annual inflation adjustment doesn't create a yearly tax bill you have to pay out of pocket. If you get this placement wrong, a chunk of your guaranteed advantage gets eaten by taxes on income you haven't even touched. So which one wins? Traditional bonds or a TIPS ladder? Here's a simple framework to make the decision. First, ask yourself, what is this money for, and when do I need it? A TIPS ladder is built for a specific purpose, generating predictable, inflation-adjusted income over a long time horizon. Think retirement withdrawals or funding a known future expense. It's for the safe portion of a portfolio that you genuinely don't want exposed to inflation risk. It is not a replacement for stocks if your goal is aggressive growth over decades. Second, what account will you hold it in? As we just covered, this decision changes everything. For TIPS, a tax-advantaged account is almost always the right answer to avoid that phantom income trap. A taxable account creates a headwind. A tax-advantaged account lets you keep the full advantage. And third, the most important mental shift. Are you comparing yields to past inflation or to expected future inflation? Don't dismiss this trade because you think inflation might cool down. The yield you're locking in is already calculated against the market's best guess for future inflation, a guess made by trillions of dollars in full-time traders. The point isn't to outpredict inflation. The point is to lock in a real return that beats inflation, regardless of which way it moves from here. So, my honest, no hedging take is this. If you have a meaningful, safe money allocation sitting in a traditional bond fund, a CD, or just in cash right now, this is a genuinely good moment to consider redirecting a portion of it. A TIPS ladder, built across multiple maturities and held inside a tax-advantaged account, isn't about chasing a hot trend. It's about locking in a guaranteed real yield that is currently running above its own 10-year average. It's a specific, actionable strategy that immunizes a part of your portfolio from the silent erosion of inflation. That is a rare kind of certainty in an uncertain world.